A little background about BHG. Tell us sort of what business you're in, what vertical you're operating in.
Sure. So BHG, we've been around for 20 years, a leading lending fintech in the industry. And our focus really is around providing best-in-class financial solutions to small business professionals and consumers nationwide. We started the business 20 years ago, and at that time it was around, how do we provide efficient working capital to medical professionals? And over the years, we've been able to really take that and just build on it, right? So first a working capital loan to medical professionals, then a working capital loan to all small businesses across the country. And then we started really talking to our customers, understanding what those owners at the small business level needed. And we built out an unsecured consumer loan for debt consolidation, home improvement. We built out both a commercial and consumer credit card. And most recently, we're working with providers and merchants to do point of sale financing, where we can do point of care, point of procedure, point of sale financing instantly for those same small businesses nationwide.
Okay, so then as you look back over the last 6 to 12 months and the changing environment in the macro environment, so what have you changed? How are you adapting to what's going on?
Honestly, what hasn't changed, right? In the last 6 months, when we look back, the roaring 21, right, where liquidity was, out of control, where interest rates were probably the lowest we'll ever see in our lifetime. We really, the focus for, I think, everyone was, how do we continue to grow? How do we continue to make sure that we're leveraging this, cheap capital? I think you move into, the influx of capital to both consumers and small businesses, the inflationary environment that we're in, and then all of a sudden you go through the rise in interest rates and really that suck of liquidity, and the business changes drastically. I think it was the fastest move in interest rates since the 80s. What we really had to focus on was, what matters, right? How do we make sure that we're focusing on the bottom line? How do we get efficient? How do we make sure that, we have the liquidity in this market to last for the long term? So our focus has really been, looking back inside the business, focusing on the customers we know, and making sure that, in these changing environments, we are ready for it, right? We're in kind of that agile mentality.
Right, well, speaking of agile, as I said, we've got interest rates that have moved 500 basis points basically over the last year and a half, and we don't know whether they've hit the ceiling yet even now. So, I imagine you've had to adjust the interest rates you're charging, right, as they've climbed.
Yeah, one of the things that we really looked at is, obviously, like many lenders in this room, you see that cost of funds start to move up, and it's a direct impact to margin, and it limits the amount of customers that you can really go after when you're running your ROI models to understand, who should you be targeting. Fortunately, what we've taken is really that test and learn approach, where we went out there and said, where can we pass those interest rate rises on to our customers? What we've seen is it is a test and learn. It's not going to work everywhere. You've got to have different strategies for the different customers you're working with. But we have been able to move most of that interest rate rise onto the borrower side, and be able to continue to maintain margins and continue to focus on growing the business.
Right. Why don't you describe your sort of the unique funding model that you have, where you've got a marketplace and a whole bunch of different banks. Just describe how that works.
Definitely. So, really, when we think of BHG, the backbone of our business has really been, our diversification of funding. And I look at it really 3 pillars today. The first pillar was really what the company was built off of, which is partnering with community banks nationwide and being able to build a bank marketplace where they can come in, find quality assets, and purchase them on a daily basis. Today, that marketplace is over 1,500 banks strong, all over the country, in every single state across the country. And we move between 10 and 20 million in assets a day through multiple sales channels on that marketplace. What we've really focused on over the years is, how do we build on that? How do we differentiate? How do we make sure in liquidity environments like we're in, we have other outlets And what we really focus on is building out a capital markets division. So over the last 5 to 6 years, we've added 2 more pillars to kind of that diversification. One, the ABS markets, where we've gone with multiple transactions over the last few years. And then most recently, really working in committed capital, right? Direct forward flow relationships with different private equity. And I truly believe that in this market and in any market, that liquidity and that diversification is probably the biggest competitive moat for a lender today.
Right, and I imagine that would enable you to kind of still serve a broader credit box, because everyone's going to have different appetite for risk, right? So how, maybe you can just talk a little bit about that, about how you kind of, that diversified model, what impact that's had on being able to kind of offer still to a broader base of borrowers.
So, in this environment, I think everyone's moving, or at least our thought is we want to move up credit, right? We want to go after quality over quantity. But the diversification of the funding group has allowed us to test in the markets more easily. So if we can partner with one of our community banks, if we can find one of our funding partners that is comfortable with one of our expansion areas, it has allowed us to come up with some of the longest terms in the industry for small business and consumer. We were able to push that term past the traditional maybe 36 or 60-month term on our consumer loan and go out to 10 years, create more affordable payments. And the diversification of the back end allows you to do that, right? Because you're not going straight into an ABS market where maybe the market's not used to that yet. Instead, you have some of your community banks, you have some strategic partners that you're able to test into that, prove the performance, and then launch that across the larger base.
Right, so I mentioned, because those guys are going to hold it on their balance sheet for the duration of the not going to sell.
That's also been a focus of ours, that we have a unique model where we can set up different structures for being on sale. If we're selling direct to those banks and it's a true sale, but it also allows us over the years as we've built our balance sheet to hold some of that test and learn on balance sheet. And grow those earnings over time to really balance the company. So that, we talk about building that woodshed, right? So for, as you go through cycles, you have that interest earning that's compounding and coming in, well, you also are selling into your gain on sale model.
Right. So then, how are you focusing on credit today specifically, given what the environment is?
I think the best word is, quality over quantity, right? Because I'll tell you what we're not doing, right? We're not diving deeper into credit bands. We're not looking aggressively at expansion areas. We're instead trying to find the highest quality borrowers that are coming in the door. When we look at, even as recent as at the end of last year, we were doing about the same lead volume that we are today, but we are doing probably about 20% less fundings, primarily based on just tightening that credit box, right? Focusing a little bit more on that prime to super prime borrower, focusing on a customer that is a little bit more well-heeled from a cash flow standpoint.
Right. And curious about you've been around, as you said, for more than 20 years. You went through the previous financial crisis in 08, 09. And you're a profitable fintech. That's not all that common in today's environment. I'm curious about how you do that. How do you maintain profitability for year in, year out, even during difficult times?
I think it starts from really our founders and owners and kind of the mentality of the business. When we look at the business we're doing today, we're not doing loans that we're not making money on the first loan, right? We're not acquiring customers just to acquire customers without having the right margin, the right profitability, even at that unit level. So our focus from day one has been on that bottom line growth. And yes, we love being able to help more and more customers across the country, but we want to take a prudent approach in terms of growth to make sure that we're doing it the right way, to make sure that we can sustain multiple cycles, and to make sure that we're here for the future. So for us, I think it starts with just that mentality with our executive team, with the rest of the organization. And then from a more technical standpoint, it's that balancing act of being able to drive the back end through both gain on sale and balance sheet to be able to create income today or income tomorrow, and be able to really position the finances of the company correctly as we move forward.
Interesting. So then, I'd love to get your perspective as we've seen the growth of fintech lending over the last decade, and obviously there's been a bit of a downturn in the industry in the last 12 months, but I'd love to sort of you've witnessed this almost growth at all costs. You'd see, particularly when the company's stock prices were going up, there were lots of pressure to grow these publicly traded fintech lenders. But I'm curious to from your perspective, how have you viewed this kind of grow mentality? When you described there, it's like only grow if you can grow profitably. How have you viewed that from how do you look at the rest of the industry?
I think, we've always been looking at times, depending on, where value is, right? There's a misunderstanding of, how is that value warranted at these levels, right? So, it's been a confusing time period when you look at moving through, the teens. Obviously, the pandemic was an interesting time, but then post-pandemic, companies in our industry and the technology industry, the values were out of control, right? Great for some, but not sustainable, right? And so I think for us, it's been trying to not get caught in that craziness as much as possible, keeping the blinders on just a little bit, just to make sure that we're not getting caught up in the frenzy and putting ourselves in a tough spot for the future. So, that grow we just hasn't necessarily been core to BHG from day one. And I think as we look to the future, we will continue to focus on what we know, focus on where we think we can be profitable, where we think we can win, right? And I think we also have a small division called BHG where we take small equity pieces in some up-and-coming fintechs. And I think the era of an idea on a piece of paper, in VC or private equity coming in and getting these crazy valuations is over. Is what we're seeing. Right?
They never come back. Yes.
I don't think so. I think it's a decent kind of push back to the middle, right? We need those companies, our company. We need that path to profitability. There's got to be a plan on how you're going to get there. In this environment, where the funding environment is right now, we're telling our portfolio companies, to have 12 to 18 months of liquidity, right? Because it's not necessarily the right time to raise, and they've got to hunker down, focus on the operating side of the business, focus on running lean, and make sure that they can get through the cycle.
Right. So then, what are your thoughts on adding new products? You talked earlier about you've been able to test some products and different funding sources that have helped you do that. What about today? How do you view kind of launching a new product in an environment like we have today?
I think it's a double-edged sword. I think, today you need to make sure that the core business is focused on your profitable areas that are going to keep the business running right now. I think the other side of that sword is that you don't want to be Blockbuster, you want to be Netflix, right? And I think that's a big deal. So, it's more about balance. It's making sure that, yes, you have some irons in the fire, you're testing and learning in areas, but you're doing it in a tactful way, and making sure that you're watching cash, you're watching spend, you're understanding the operating expense of where that R&D is, and making sure that budget is relative to the environment that we're in.
Right. So the title of this session is Double Down on What You Know. And can you just maybe tease that out a little bit as far as how is BHG doubling down today?
I think for us, we have had a extreme focus in the kind of small business working capital loan, and really that unsecured consumer. So our core focus for 2023 is continue to be there for our customers, new and existing, and make sure that we have the liquidity and capital to make loans every day. And I think, yes, we have some amazing other products, but our growth for 2023 is going to come from our core products. And that's really what it means to double down on what we know, is making sure that we are blocking and tackling, making sure that we're grinding, making sure that we're going in, and from an operating expense side, we're getting as lean as we can. From a focus, we are making sure that we're fine-tuning our processes, we're growing our different products that are most profitable today, and maybe leaning out a little bit on the other areas. I think our foot is a little bit off the gas in that area, but not fully off the gas, because at the end of the day, as we look to the future, we still need those other areas for opportunity. We still want to make sure that we're staying relevant in the market we're in. I think, Fintech in general, and in the lending space, it is around a little bit innovate or die, right? You've got to continue to iterate. You've got to make sure that you're bringing your customers the best-in-class products and the best-in-class experience, to make sure that they're coming back to you and not one of your competitors.
Right. Okay. So I want to go back to the bank partners just for a second, because I talked with your CEO Al earlier today, and he mentioned, like, we've had the SVB crisis. Hopefully there's no other banks that are going to go under. We don't know, but a lot of it was a lot of talk about holding these long duration paper. And I'm just curious about how your conversations have gone with your bank partners over the last, whatever it's been, 6-8 weeks. It sounds like there's a lot of talk there, right?
There is. I think it comes with the rise in cost of funds, right? We've seen our cost of funds go up dramatically. And the banks, because of the diversification of our base, there is liquidity. There are deposits, and these banks need to go out and make earnings, right? They need to reinvest. And, fortunately, with our product, we've been working with many of these banks for 20 years, for 10 years, for 6 years, for 5 years. So there is, confidence in what we've provided to them. There's confidence in the performance, which definitely helps having those relationships and building that base. And then I think we've also had to price for it, right? We've had to be conscious of where we were in 21 and kind of where loans were selling on our auction marketplace were there, and it looks much different today. But like I said, fortunately, the consumer also understands that a little bit today. The small business understands that. They see where their mortgage rates are, where their credit card rates are, and there's a decent understanding because of the publicity that's been out there around the rise in rates that the cost of lending is no longer the same for borrowers as it was just 6, 9, 12 months ago.
Right. You're not in the real estate space where we used to 3%.
Yes.
Right? So,
luckily, we always had a little bit of margin in there, so we're not having to compete down there.
Yeah. Got it. Okay. So last question then. When you look through the rest of the year, we've got 7.5 months left in the year. What's your outlook?
I think we're hopeful. I think we hope that this was the last increase that we'll see for the rest of this year, and maybe there's a chance we see as we move into 24, getting a little bit back to normal on the interest rate side. I think the inflationary environment starts to be a little bit more under control. I think the small business and the consumer has still been pretty strong out there. I still think there's a lot of unknown. So, for us, it's definitely a grind year. And, one of the things that we talk a lot about in our executive conversations is, in years like this, it's to use a football analogy, right? 3 yards down the field scores touchdowns. So, it's getting those little wins. It's making sure that we're doing what we can. It is that block and tackling and making sure that we're also learning. You know, you learn a ton in cycles like this. Yes, you're going to have a little bit of pain. We're all going to have a little bit of pain. But at the end of the day, if you can learn from it, if you can position yourself to be here for the long term, you're better set up for the future, for the growth years to come.
Okay, well, that's a little bit there, Tyler. Thanks so much for joining us on the Keynote stage today.
Thank you. Appreciate it.